Nedbank's full-year diluted headline earnings per share jumped 25% to 1,340 cents. The bank also posted an 8.6% increase in net interest income to 18 billion rand. Joining us in studio now to unpack the results with us is the company's CEO, Mike Brown. Thanks so much, Mike, for joining us this afternoon.
Pleasure to be
Well,
here.
there we have it. So the company achieving a record level on a headline earnings basis, underpinned by the repositioning of Nedbank Retail, growing non-interest revenue as well. It seems like somewhat of the re-strategy is working for the company right now.
Yeah, certainly we were very pleased with the results. I think 26% up at a headline earnings level, over 30% up on a profit before tax level. The frontline clusters were up over 30%, so those are all a really good outcome in what still is a pretty tough market. Our ROE was up nicely to 15.3%, but we know we've still got more work to do. We need to get that number closer to our target of cost of equity plus 5, which is probably 18 or 19. So, a really pleasing outcome, but more work ahead.
Of course, you've mentioned that there's work to be done in getting those ROE levels up. We've seen progress, but still lagging First Rand, which sits at about 19.5 right now. So you're mentioning that there's room to stretch that further. You've got a target of 18 or 19%. What kind of timeline have you put for that target to be met?
So we haven't put a specific timeline. We say we want to hit it over the medium to longer term. Clearly, a lot of that is dependent upon what happens in the macroeconomic environment. And right now, a big chunk of that's going to be driven out of how Europe eventually resolves the challenges that it currently has. But if we think about the kinds of things that are likely to drive our return on equity higher, firstly, our bad debts or credit loss ratio was at 1.14%. We think we can get that down below 1% in the current year. So that's certainly going to feed into the ROEs. Secondly, we have a target to get our non-interest revenue to expenses to 85%. We're currently sitting at 81.5%. We had really good non-interest revenue growth of nearly 17%. But as that moves closer to 85%, that's also going to feed into ROEs. And really, if you look at our businesses, we've got great wholesale businesses, all producing above 20% ROE. Our retail business had fantastic growth in earnings, 160% up, but its ROE is still below the cost of equity.
Yeah.
So that's where the ROE rise also has to come from.
Of course, in the past, that retail business consumed a large part of balance sheet assets and generated a small return, in return. One gets a sense that relationship is now slowly starting to correct. So to what degree are we seeing that correction happen?
We certainly are. The ROE in our retail business a year ago was just over 4%, and it's now a touch under 12%. So that's a fantastically strong year-on-year performance financially. But what's really more exciting is that if you look underneath the business to see what's going on to drive that growth, we added nearly 160,000 new primary customers in our retail business. We've launched, I think, some fantastic products.
Where exactly are those customers coming through from? Because amidst those products coming to the market is a focus on that lower end of the market specifically.
So it's certainly a mix. We've seen reasonable growth in the middle market environment, but we've got a lot of focus on what we call entry-level banking and the youth environment. And we're starting to see some really nice uptick in that space. We've done things like rolled out another 121 staffed outlets during the course of last year, nearly 400 ATMs. 59 of our branches now have extended banking hours. So there's a lot of activity going underneath that, which is leading to a strong improvement in our retail franchise. You
touched on the fact that you're looking to increase your non-interest revenue and to grow that, in low double digits earlier on. You're setting a target of what you said, 85%. That's usually done via fees or commission. So how exactly are you, planning to roll this out and hit those targets, which seem very ambitious right now?
So, we've seen good growth last year. So we've got a track record of delivering 17% up from an NIR perspective. We have increased our distribution platforms, which are the base for rolling out transactional activity. We've also done quite a lot in our IT environment to improve our IT systems. We've also seen very, very strong growth in general transactional activity, particularly on our electronic banking platforms. Very strong growth in our insurance businesses. We took 100% ownership of those about 3 years ago. Those are very tightly aligned to growth in things like our personal loans business. So there's a lot going on that we think does put some momentum and sustainability in the underlying NIR growth. Fee increases have been roughly in line with inflation. And in fact, if you look at Nedbank's fees, our current bank charges are probably at very similar levels to what they were like in 2005.
Is that going to be the name of the game for a long time yet? Because one would only assume that it's going to be tough to pass on any fees that are higher than just, countering in or factoring in those inflationary increases.
I think you're right. For quite a while we've had either inflation or lower than inflation fee increases. We took quite a big cut in our fees probably back in 2007, 2008. So it's much more a volume and transactional game than a fee increase game.
Of course, we've got household demand for credit remaining stable, that transactional demand continuing to strengthen as well, as you've highlighted. The group's impairment charge moving lower, declining 14%. What's happening on the corporate side of things? Corporate credit demand seemed to have been gaining some traction towards the end of last year.
Yeah, so what's interesting, if you take our whole book, it grew by just over 4% during the course of the year. But if you look underneath that, we paid out 116 billion rand in new loans. We obviously get quite a lot of repayments and early settlements coming back the other way. So on the corporate side, generally what you've still got is corporate South Africa sitting on large amounts of cash, and given the uncertainty, particularly in the European environment, not pushing the button on large projects. Now, what was great to see was quite a lot of activity picking up in the fourth quarter of last year. So we saw some really nice payaways on the wholesale side of our business. Our credit-approved pipelines right now are much stronger than they were a year ago. So I think that there is some potential for increased momentum on the wholesale side.
That within South Africa's borders, let's take it across the borders here, because you've entered this very strategic partnership with the EcoBank and you've secured rights to in fact acquire up to 20% of EcoBank Transnational. How's that strategy paying off for Nedbank outside of South Africa's borders?
I think it's a great strategy for both of our businesses, EcoBank and Nedbank. This is an alliance that we've been in together for 4 or 5 years, and we've grown to know each other very well. We were able to support them with their corporate development objectives. They've just undertaken a very big merger in Nigeria with a bank there called Oceanic. The combined operations will now be probably number 3 by footprint and number 5 by assets. So it's really a transformational merger for EcoBank, and we were very happy to be able to support them with a loan that does have potential to be exchanged for equity somewhere further out.
So where that option does stand, up to 20% of EcoBank Transnational incorporated within 2 to 3 years, is that looking more likely than not?
Yeah, so certainly from our perspective, we've always entered into the relationship on the basis that that's a transaction we would like to execute on. Otherwise, we wouldn't have done it in the first place. But clearly what we're going to do is over the next 2 years, continue to work really closely with Arnold and his team, who are our partners in this. And then we'll only finally take a decision somewhere between month 24 and 36. But I think what's really, really interesting is that if you look at the combined footprint of the two operations across the African continent, it's unrivaled. 36 African countries, more than 2,000 points of presence between our two organizations. So it really is a very strong footprint on a combined basis.
Well, certainly something to look at, giving Nedbank the edge, I would assume, with companies like Standard Bank already having made progress in African territories. Mike, thanks so much for having joined us this afternoon. Of course, Mike Brown is the CEO of Nedbank.